Ready to go? We're
Take it
all
away.
ears.
All right, awesome. I'm going to share my screen. I'm going to bring up some slides for you guys. All right, Joe, can you see that okay? Can everyone see that okay?
Yep, looks good.
All right,
Yeah.
awesome.
Yeah,
Awesome, awesome. Well, gentlemen, thanks for setting aside the time to join me on a weeknight like this. Really appreciate it. Basically, I'm a financial advisor. Essentially, what that means is I help individuals and families to accumulate the amount of money, save the right amount, put it in the right places, invest that money the right way so that they can reach whatever their financial goals are. For most of my clients, their main financial goal is to make sure that they can one day retire comfortably so that they can stop working when they want to and have built up enough money to be able to give themselves the income that they need to live comfortably. And that takes, decades of saving the right way and investing the right way. So I probably have about 800 individuals that I work with, manage about $400 million across them. And I have clients who are teenagers. I have clients who are in their 90s. I have clients that have a lot of money. I have clients that don't have a lot of money. I've seen the strategies that have worked really well firsthand, and I've seen mistakes get made again and again and again. So what I wanted to do over the course of this series of 3 weeks was really put together a presentation of what I feel like are the important fundamentals to managing our personal finances. And my goal is that if you guys were to attend all 3 of these and you kind of grasped everything that we talked about, that you'd walk away with a really, really solid base. And be prepared to, as soon as you started to get that steady paycheck, know exactly what to do with it. I'll also tell you, I did tailor these slides and this presentation to you guys, but 90% of it, literally probably 90% of it, is based on presentations that I've given repeatedly to the medical students at Upstate Hospital, that I've given repeatedly to the faculty and staff at Cornell University. And so, this is stuff that while I want it to be basic, it's hugely, hugely important and people are really interested in. And Joe and I were talking a little bit one-on-one beforehand. It's something that I actually think that you're in a better position to be hearing than all of these other people that I've been sharing this information with, because so much is in front of you. You haven't made some of those huge purchases. You haven't started off. I know a lot of you guys are working, but maybe you haven't quite started that career yet. And so it's really hard to financially backtrack once you've spent too much on your house, or once you've kind of you've taken on a bigger loan than you should have. But if all those things are in front of you and you grasp these concepts ahead of time, I think you guys are going to be in awesome shape. So ask me questions as we go along. I'll try to be good about pausing at various points. We'll hang out after and answer any questions, but I hope you find it to be valuable. Today, I just want to hit on some of the key concepts, because I think these things we talk about over the next 3 weeks are going to build on one another. So I want to make sure that everything unfolds in a way that makes sense. We're going to talk about income. We're going to talk about enhancing our income. We'll talk about taxes today, debt, and credit scores. And the plan for the next couple weeks will be next Wednesday, we'll talk about budgeting. This is a big topic, but kind of relies on some of the things that we'll talk about today. And then a couple weeks from now on the 16th, we're going to talk about and focus on investing money. So I want to start with the topic of income. Obviously, if we don't have a comfortable income for ourselves one day, there's not a lot that we can do to avoid staying out of debt, to avoid to be able to to be able to save adequately, to invest money. We need to have a stable level of income. So this is something that's pretty important. I want to talk about the various different types and the important components to it. So when you guys kind of start off on your careers, generally you're going to get compensated in one or a couple of different ways. The common ways are salary, hourly wage, and project-based income. So when you start with a job that's going to pay you a salary is payment to a permanent employee for performing kind of contractually agreed upon job duties, regardless of the amount of time that they actually work on the job. So a lot of times when you start with a job that pays you a salary, they're going to tell you this annual figure that they're going to pay you. So in my example that I'll use throughout the presentation, $48,000 a year. And you're paid that if a normal work week is 40 hours, 8 hours a day, 5 days a week. If you have to work really hard because you got to meet a deadline and you work 75 hours that week, you still get the same paycheck. If you only work a fraction of the week, you leave early a few days, you're still getting the same paycheck. If an employer were to pay you 48 grand at the beginning of the year and not pay you again, it would be really hard to manage that. So what most employers do is they pay you more frequently, whether that be weekly, twice a month, monthly, so that annual salary gets actually paid to you in installments. So in my example that we'll see again in this presentation, I kind of assume that people are getting paid 2 times a month, which would be every paycheck you get 2 grand over the course of 24 paychecks. That's $48,000 a year. So hourly wage is a little different. Hourly wage is completely contingent upon how much you work. You and the employer agree upon a dollar amount that you're going to get paid each hour. This is probably the way that, those of you guys who are working now are being compensated. So you agree upon an hourly rate, and the more you work, the more money you get paid. The less you work, the less money you make. So 40 hours a week, every week of the year would mean that someone who earns $15 an hour would make about $41,000 a year. Now, if you didn't work that much, maybe you only worked 1,500 hours in a year because you didn't want to, or because the employer didn't have the shifts that you needed, that's going to dramatically change your income. Someone who only works 15 hours a year at 15 bucks an hour, only going to bring home about $22,000 a year. Now, to protect employers to protect employees, I should say, from being totally taken advantage of by an employer, there is something called the minimum wage out there. The minimum wage governs the minimum amount that an employer needs to pay their employees. And this is different from state to state. And even within New York State, it's different from region to region. So there's actually a different minimum wage in New York City than there is here in central New York. And a few years ago, the state decided that they were going to try to bump up that minimum wage, but do so slowly so that businesses would have time to adjust to this increase that they were going to have to pay employees. And so I wanted you guys to know, if any of you guys are working in jobs where you're being paid minimum wage, at the end of December of this month, it's going to be required that the minimum wage go up to $12.50 an hour. I think it might be like $11.80 now. So I want you guys to know that if you're working in a job where you're making minimum wage, you're going to be entitled to a little bit more money coming up here. Also, project-based income. So this is another way that people commonly get paid, largely for people who kind of work for themselves. So this is when you get paid for performing a specific project or a specific service. So a web designer might say, hey, small business, I'll charge you $7,500 to create a website. Once they're done with that website, they go on to their next customer. If they have a lot of customers they make websites for, they'll make a lot of money. If they don't do a lot of it, they're not going to make a lot of money. An Uber driver, same concept, different sort of arrangement. They make a percentage of their ride fare. So if they give a lot of rides to people, they'll make more money. They give very few rides to people, not going to make a lot of money. So these are kind of the common ways that people are paid once they start their career. Enhancing our income. I mentioned that our income is going to be the important starting point for making sure that we have a sound budget to manage. So we also want to make sure that we know how to grow it over time. I would say the most important way that we can improve our income potential is by furthering our education and training. There is a lot of data on this, and this is from the US Census Bureau. What they've found is that there is a very, very direct correlation between the amount of education that people attain and what their average annual income is, and therefore lifetime earnings. So if you guys can see my screen, what I have up is a chart that shows us the average annual earnings nationally of people who have attained certain education levels. So someone who didn't finish high school, average earnings about 20 grand a year. Someone who has a college degree but nothing beyond that, about 30 grand a year. Maybe you went to college but didn't finish, didn't get that degree, about 32 grand a year. If you have an associate's degree from a community college, say, about $39,000 a year. If you finished and got your bachelor's degree from college, about $56,000 a year. And it goes up and up from there if you get a master's, PhD, medical degree, and so on. Now, I want to point out here that the difference then between somebody who has a bachelor's degree and averages 56 grand a year and someone who only has a high school degree, 30 grand a year, that's a $26,000 annual difference. That means that someone with a bachelor's earns double what somebody with a high school degree makes on average. And that means that over the course of your working career, that person with a bachelor's is going to literally make millions of dollars more than someone who only has a high school degree. So, at the point that you guys are at, I'm sure a lot of people are starting to talk with you guys about college for a lot of different reasons. But to me, the proof is in these hard numbers here. The more education that you guys strive for, the more dollars you should expect to earn over the course of a year and over the course of your career. So once we start our career, we're getting that income and that salary or whatever the structure is that we're getting paid. One of the other ways that our compensation can go up is through raises. So a raise is an increase to your ongoing compensation. It's a permanent increase as opposed to just a one-time bonus. There are two general types of raises once you start working permanently. So one is a performance-based raise, and like it sounds, it's usually given to people who have above average performance. They go above and beyond. They do especially well. They get a performance-based bonus, a performance-based raise. Now, sometimes you have to ask for this. You need to tell your employer, look, here's what's expected. Here's what I did. Here's why it was exemplary. You need to ask for it. Sometimes the employer will notice it and kind of approach you with it. But in any case, here's my example. You get a performance-based raise of 10%. That means somebody who had a $48,000 salary, once they get that 10% raise, the next year and every year going forward, they're going to have a salary of $52,800. So that's going to permanently increase their income. The other type of raise is something called a cost of living raise. And this is something based on the reason why people get cost of living raises is because of a concept called inflation. Inflation is just this concept that as time goes on, the cost of the things we spend our money on, from food to college, to movie tickets, all of this stuff, if you think about what it cost 10 years ago, 20 years ago, the price today is dramatically higher. So to help people keep up with these rising costs that we're spending our money on, employers will give cost of living raises, usually between 1% to 3% per year. That's kind of the average inflation rate in the United States. And these cost of living raises, when they are given, tend to go to everybody in the same amount. So this is not usually a performance-based raise. This is something that goes to everybody. And just to kind of give you a quantitative example, if you're making $15 an hour or about $600 a week, and you get a 2% raise, that means your hourly wage is going to go to about $15.30 an hour. It's going to bump up that weekly income just a little bit. All right, so I just wanted to kind of hit on some of those basic income concepts before we shift into taxes a little bit. Let me just pause and see if there's any questions so far.
What do you think, guys? Anybody got a question?
Yeah, I do.
So for the no, you got it. Go ahead.
Go ahead,
Okay.
Makachu.
So my question was, like, how often does a cost of living raise usually happen? Is it like every 2 years, every like 5 years?
Yeah, it's a great question. So, it depends on the employer. It depends on the economic environment, actually. So if inflation is rampant and costs are really rising out there in the economy, it might be every year. So every year, I would say the most common cost of living increase happens every year, actually. But there are some years where there is not much inflation. This is something that's measured by the U.S. government and reported. So if employers know, hey, there wasn't really much inflation this year, they might not give a cost of living raise. But I would say generally it's common to get one every year.
Welly, you got a question?
Yeah, I had a question. So, like, employees, they get raises some of them get raises based on how the company's doing, right?
Yeah, absolutely. And that can have that can take the form of a couple different ways, so some of it might be kind of fall into that performance-based raise where the company says, hey, we had a great year, you played a big role in that important year, so we're going to give you this 10% raise. Sometimes they do it in a form called profit sharing, which essentially is more like a bonus where they say, hey, we had a great year this year. We don't know what next year is going to look like, so we don't want to commit to giving you a permanent raise. Instead, we're going to give you this profit sharing or bonus where we give you an extra $1,000, $10,000, whatever it is. It's kind of a one-time payment. So companies that want to compensate people because they have a great year, but they're not so sure that that's going to continue from one year to the next, they might do it more as a bonus than they would do it as a raise.
Man, I should have got bonuses for every game I won as a coach, man.
That's right. All right, so I want to shift gears a little bit to taxes. We talked about income, we talked about kind of the amounts that an employer, or if you're self-employed, a customer is going to pay you. Amount hitting our bank accounts that we use for our savings, for our investing, that's going to be a much lower amount. And the reason why the amount that's hitting our bank account is so much less than the amount that the employer is paying us is because of this concept of taxes. And I would say, that people's lack of understanding of the impact of taxes gets a lot of people into a lot of trouble, regardless of where they're at, income-wise. This gets people into trouble at high income levels and low income levels. So I definitely want to make sure we hit on this topic. Well, what are taxes? Basically, taxes are required payments that we all have to make when we earn income to various levels of government in exchange for the programs and services that governments provide. So governments, whether we're talking about the federal government, state level, state government, whatever, they provide some really essential services to us that private companies either would not provide at all because there was no profit in it, or that they wouldn't provide to everyone that would necessarily need it. So governments play a really important role, but the way that any government has money is mainly through, taxing the people. And so there are different types of taxes. There's income taxes, property taxes, school taxes. Really, I'm just going to focus mostly on income taxes because that's going to be the biggest chunk, and it's going to be the type of tax that directly impacts our income. In the United States, we have what's called a progressive tax system, which means that as you earn higher levels of income, we pay higher percentages of taxes. So if you ever heard people say, oh, I'm in the highest tax bracket, or if I earn a little bit more, that's going to bump me into the next tax bracket, that's what they're referring to. At different income levels, you pay a different tax percentage. And in general, the more money you make, the higher the tax percentage is. That's the progressive tax system in the United States for income tax. I just want to kind of expand on the purpose of taxes a little bit. So where do our income taxes go? Well, at the federal level, they go to things like funding the military, funding defense for the country, health and retirement programs. Odds are, if you guys know somebody who's 60 or older and they're no longer working, they're probably getting health coverage through a federal program called Medicare, and they're probably getting a pretty important monthly check from a federal retirement program called Social Security. These are hugely important programs that millions of people are on, and they are funded primarily through taxes. Some other ones that probably jump out at us, aid to states. So let's say, there's a wildfire in California, there's a hurricane hitting the coast. Some of these little impacted counties and communities, they don't have the funds to completely rebuild from that stuff. So the federal government needs to provide them with money. Research, the federal government, it was projected, was going to need to spend $9 billion on manufacturing and developing a COVID vaccine. Obviously hugely important, but it takes money, and that's where they get money from, is taxes. State level too goes to some really important but different purposes. Schools, you guys, I think all go to public school. I went to a public school. This is how the teachers are paid, the buildings are maintained, and so on. Roads, transportation, fire and police departments, state level health programs. Again, taxes go to important things, but it does come from us, and so it does impact our after-tax income. So to facilitate the payment of these taxes, if you are an employee of a company, what they tend to do is that they'll take the amount of taxes, an estimated amount of taxes, right from every paycheck, and they'll send it to the federal or the state governments, and then they'll send you kind of the remainder of that. If you're self-employed, like me, for example, I have to write a check to the federal government and write a check to the state government every quarter to do that because I don't get a traditional paycheck from an employer. But regardless of how these taxes are paid, in what format, taxes will reduce the amount of income that we have at our disposal to spend. And this really, really is a huge concept to make sure that we are budgeting our money correctly, because we're going to have less of it than what our employer says they're going to pay us. That's actually hitting our bank account. So let me give you an example here. Our employer says we're going to pay you a salary of $48,000. Now, again, if they pay us twice a month, that should be $2,000 every paycheck, or $4,000 a month. What they'll do is they'll take some taxes from that, though. So in my example, if they take 20% for taxes, that means that they're going to send $400 away for taxes, and instead of $2,000, they're going to deposit $1,600 in your bank account. And by the way, this is a really simple example. There's a lot of other things that come out of the paycheck. I'm sure Joe can attest to that. And so this is a pretty rosy example here, that you're only getting $1,600 hitting the bank account. So that means instead of getting $4,000 a month like you would have thought, you're only getting $3,200 a month. Or in other words, you're only taking home $38,400 at the end of every year, instead of that $48,000 annual salary that the employer is paying to you. This is not just a concept that impacts, you and I. This is something that impacts everybody in a big, big way. And so what I have up on the screen are the numbers for LeBron James when he was in Cleveland. So it's a couple years old, but Cleveland said, LeBron, we're going to pay you $33 million a year. Now, obviously a crazy dollar amount. If LeBron had said, you know what, that's awesome. I'm going to go out and I'm going to buy myself a fleet of Lamborghinis, spend $25 million on that, and I'll still have $8 million left over. That should be fine. I'll come back to that. There's some other things that are coming out of his check here. But look at what he pays in federal taxes, about $12 million. Look what he pays to the city and state in taxes, about $2 million. So $14 million is going away in taxes. What is hitting his bank account is only about $16 million at the end of every year. Now, that is an amount that Joe and I and maybe even you guys can't even fathom making in a single year. But the concept that I want you guys to see here is the percentage. He is only bringing home 50% of what his before tax income is, because of how big of an impact taxes have. So to go back to my example, if LeBron spent $25 million on his fleet of Lamborghinis and thought that he was going to have this nice cushion left over, not only is he not going to have a cushion, but he's going to be pretty significantly in debt, because again, what's hitting his bank account is only 16 million of the 33 million every year. So this impacts athletes, celebrities, high income earners, low income earners. Taxes impact us all. It means that the after-tax amount we'll take home to live off of is much less than the top level of income that our employer is going to pay us. All right, so I kind of scratched the surface of taxes. I could probably go on and on for days on that. Let me pause here.
Yeah, Abdueli.
Isn't the escrow how the league did? Isn't that what that is? And how it affects their paycheck?
Yeah. So the escrow kind of helps to maintain that there's a certain cushion there. And that's what you're kind of seeing in these slides here. There's some escrow that's being taken out. There's some escrow that's credited back. But regardless of that, and to be honest with you, I don't even understand all the complex nuances of that. I focused mainly on just this tax piece of it and how big of a deal that is. I mean, athletes' taxes to me are fascinating, because they basically get hit with taxes in every city that they play. So if they play in New York City, they got to pay New York tax. If they play in California, they got to pay California tax. An athlete's tax and income situation is just fascinating. But I thought that LeBron's example was just interesting as to how much taxes he paid.
Yeah, it was. Thank you.
Yeah, good question.
Any other tax question?
All righty. I'm going to shift gears here a little bit and talk about debt next. And so what is debt? Debt is basically just borrowing money that's going to help you purchase an item or service. So there are so many important things that are really expensive, and we just don't have the money in our pockets to be able to purchase this really, really expensive but valuable item. And so we need to borrow it. And so what happens when we take on debt is that some lender provides us with the money we need right now in exchange for our commitment and promise to repay them over a specified length of time with interest. So to give you some examples, I mean, while the item might be different, the path is always the same. So buying a house, I don't have 150 grand in my pocket to just buy the house I want outright. I need to go to a bank and get a mortgage, which is the term for the type of loan for buying a piece of property. So the bank gives me the mortgage or the loan. I buy the house from the seller. I then pay the lender back over time. And at the end of that time period, I own the home outright. I could sell it if I wanted and make the full amount of money from that. Buying a car, I don't have the $25,000, $30,000 I want to buy the car I want in my pocket. So I approach the bank. If they approve me, they give me a loan. I buy the car from the dealership or the seller. I pay back the person who lent me the money. At the end of it, I own the car outright. College, different type of commodity, but the path is still the same. We don't have enough money to pay the pretty expensive tuition out of pocket. We receive the loan, we pay for college, we pay the student loan lender back. So same sort of steps to all types of loans in general. Why would a lender give us money? Are these men and women that work at the banks and the credit unions just the nicest in the world? They might be. Many of them are. However, the real reason that they are in business, at least, is because of a concept called interest. Really important concept to grasp. So interest is usually expressed in annual terms. So you might hear, oh, 3% interest rate, 6% interest rate, 20% interest rate. That is an annual figure, and it's charged on any outstanding amount of money that you borrowed but you haven't repaid yet. So I want to give you an example. And Joe, this on an unrelated matter, I want to talk to you about something after the meeting. So Joe lends Brendan 10 grand for 1 year at 5% interest.
A nice guy.
And 5% interest on 10 grand is $500. So that means that after 1 year, I would have to pay Joe $10,500 after borrowing 10 grand. So I helped because I was given money that I needed when I didn't have it. Joe, what was in it for Joe is that he ended up making $500 after 1 year's time. And Joe, I was just kidding. I don't need 10 grand from you. You're off the hook for now. All right, but where it gets more complex is that a lot of loans, they span a number of years, so the amount of outstanding principal is declining, and we're paying for a long time. So let's look at an example where I'm buying a house. I need to borrow $150,000 to purchase the home, and I then need to pay the lender back over 30 years. And by the way, this is common. A 30-year mortgage is a very common length of time when you buy a home. So I'm paying the bank over 30 years at 4% interest, which is pretty much where they're at now. And this is at historically pretty low levels. Right. Now, 4% doesn't sound too bad, but look at this. Look at these numbers. After 30 years, I would have paid the bank $258,000 after borrowing just 150 grand. That's $108,000 in interest. So that's why there are lenders. That's why a lender is extending loans to people, is because they're making the interest. We get the money we need at the time we need it, but we're going to have to pay interest for it. So in terms of the logistics, all loans kind of have these things in common, I would say. One, there's an interest rate that's agreed upon. Two, there's a repayment length, which is the kind of time frame that you and the lender agree to as to how long it will take you to fully repay them. And 3, you agree upon a payment frequency. So some loans you might need to pay back weekly, some monthly, some annually, but there's some frequency that you agree upon. So I want to kind of give another, to me, understanding the interest and the taxes, I kind of need to see the dollars and cents to it. So I want to give you guys just another example here. So college, we talked about it before, hugely important. It's going to help my annual income quite a bit. So I want to do it, but I don't have the money, all the money I need for all the tuition. I borrow 80 grand over the course of 4 years. And I have to repay the lender over 20 years at 5.5% interest. So that means I borrow 80 grand. And they say, look, we know that you're just fresh out of school. You can't pay us 40 grand over 2 years. So why don't you pay us monthly as you get your paycheck from your employer? And if you're going to pay us over 20 years, that means that you have to pay us $500 per month. Now, that $500 per month for 20 years also includes some interest. So after 20 years, I would have paid back the student loan provider $132,000 after I borrowed $80,000 from them. Now, that's just another scenario of where, even what seems like small amounts of interest over a long enough period of time on a big enough amount of money can make a huge difference. I will say, though, that this example, even though back $132,000 on an $80,000 amount borrowed sounds like a raw deal, not all debt is bad. Think about this. If I use this to get my bachelor's degree and I'm now making 26 grand more a year than if I had just started working after college, statistically, I'm going to make up for that investment that I made over a few years' time. So not all debt is bad, and that's something that I want to kind of hit on next. Debt that I would call good debt, it contains some kind of an investment element to it. So I would categorize student loans in this category. We're kind of we're borrowing money, but we're making an investment that should yield us higher earnings every year and therefore higher lifetime earnings. Mortgage, it's an essential asset. And as we kind of put money into it, we're then going to own it. And one day this house will probably be a pretty important portion of all of our net worth. Now, of course, people can still overextend themselves with these things. You can take on way more student loan debt than is prudent. You can buy a way bigger house than you should, a bit nicer car than you can afford. But if done in moderation and done in the right levels, these types of debt, I would say, are perfectly acceptable. An example of bad debt, I think the classic one is credit cards. So credit cards themselves are not bad. I put a lot of my monthly bills on credit cards. Where you can get into trouble is if you don't pay off the full balance at the end of the month, because that's when they'll start charging you interest. And credit cards, when they charge you interest, they charge you real interest. Commonly, these interest rates are going to range from 15 to 25% per year. And when you get into that level of interest and you're making payments, a lot of your payment is just going to the interest. You're not actually chipping away at the principal. And so this is where it can become really tough to actually get rid of credit card debt once it becomes an issue, and it can build and build and build from there. We saw how big of an impact even 4% interest or 5.5% interest has. I mean, think about that impact of having 25% interest. Really shocking. All right, so I'm shifting a little bit from the concept of debt to I want to kind of focus on credit scores a little bit. But before I do, why don't I pause again and just see if there's any questions?
So for debt, yeah, I forgot what I was asked. Wait, do they give a specific amount of time that you have to pay back the money?
Yeah, and it's going to be different depending on, and you have some say in this too. So you might decide, you know what, I only want a 5-year loan. I only want a 30-year mortgage, and so on and so forth. So so you'll be able to have some say in the payment length that you have. So for example, I mentioned that a 30-year loan is a common length for a mortgage. Actually, my wife and I really are buying a house right now. And so I opted for a 15-year mortgage, even though that's going to cost me a little bit more every month than it would if I paid for 30 years. I'm going to pay them much less interest over the life of it. So I opted for the 15-year loan. So whether we're talking about car loans, mortgages, things like that, a lot of times you actually as the borrower have some say in what you want the length of the loan to be.
All right, thanks.
You're welcome.
Yeah, I have a question.
Yeah.
So like do certain credit card companies charge you different interest based on like how good of a customer you are to them?
Yeah, really important question. And I'm going to take a step back even and say, regardless of whether you're an existing customer and they know that you're a reliable customer, different credit cards will offer different rates. So when you guys get to the point where you're looking at credit cards, that's one of the things you want to look at. You want to look at, if I do ever get to the point where they're going to charge me interest, what are they going to start charging me? It says it in the fine print of when you get a credit card offer. And so if everything else is equal, and one of them, if you ever owed them interest, would charge you 17% interest, and one would charge you 27%, I would lean towards the 17% one. So it can be important to kind of scan the fine print and kind of pick out what is that interest rate going to be, because you raise a really important point. It's not the same from company to company. And also there's some other things too. Some credit cards will charge an annual fee, some won't, some will have these perks but not others. So credit cards can be a bigger topic, but the interest rate is really, really important to look at. Again, if you pay off your balance in full every month, they will not charge you any interest though. So hopefully, while it's important to be aware of it, it's never something you're actually going to deal with. So I mentioned, I put a lot of my bills on my credit card. I put it on my credit card because my credit card gets me points and benefits and things like that. So that putting it on my bank card wouldn't. So I put it on my credit card, but then I'm very careful to pay the balance off because I don't actually want to pay any interest.
So like, do you just get a certain thing with your credit card and then make sure you have the money in your debit card, so when it's time to put it back into the credit card and pay it off, you can pay it off, right?
Yeah, that's exactly right. And I'll tell you exactly how I do it personally. What I do is, because I'm so paranoid of missing a payment because it's going to affect my credit score, which is what we'll talk about next. If I miss a payment, I set up I set up for an automatic minimum payment. So that might be $15 or $20. So that way, even if I don't remember on the exact day that the payment's due, it's automatically going to get paid. But I don't set it up to pay the full dollar amount because I want to go in every month and make sure that all the expenses were things I actually incurred. But then absolutely, I need to make sure there's enough money in my bank account to pay it off in full, because that's ultimately what I want to do. But the way that I personally handle is I don't have it automatically pay everything just in case there's some bill on there that wasn't actually me. I have it automatically pay the minimum payment, and then I look at it every month, all the expenses. When I say, okay, that was all me, I then pay it with my debit account balance. So my debit account is linked to my credit card statement, to my credit card. So I just few clicks and it's paid.
Yo, I like that. That's a smart move.
Yeah.
Automatically on that minimum, right? Oh, all right.
Yep, exactly. And that also allows, the other thing I'll say is that there are some months, I'm a financial advisor, and so, but there's even some months where like my credit card is more than I thought it would be. I tend to not keep crazy high cash balances. If I have excess money, I try to invest it. So if there are the other reason why I don't set it up to automatically pay my full bill is, let's say my credit card bill was $7,000 one month and I only have $5,000 in my bank account. I got to make sure I move some money into my bank account so that I can actually pay that bill. If the credit card tries to pull my $7,000 and it's not there, that's going to hurt my credit score. So that's the other reason I do it, Joe. All right, guys, so I'm going to shift gear to credit score a little bit. This is going to be our last topic, and that way we'll leave some time to kind of hit on everything, also cover everything. So we talked about debt and the importance of, having a low interest rate when we are going to be paying interest. Now, we also talked a little bit about why would a lender extend a loan to you. They do it because of interest, but they're only going to get that interest if you actually pay them throughout the entire term. it is a big risk to that lender if you don't actually end up repaying them. So they want to evaluate, before they even give you a loan, they want to evaluate the likelihood that you are going to pay them back, which is called creditworthiness. And one of the key ways that they can evaluate this is by looking at your credit score. So a credit score, which is also sometimes called a FICO score, FICO, same thing, they're synonymous, is a score that ranges between 300 to 850. And you can see on my screen here, we kind of broken down into some various categories. Basically, if you have a credit score of 740 or above, a lender is not only going to give you a loan, but they're probably going to give you some of their best rates, if not their very best rates. If you have a credit score of 580 to 670, which is fair, 670 to 740, which is good, you're also probably going to get the loan, but you're probably not going to get the best rates available. And if you have a credit score that's below 580, you're facing a possibility that the lender's not even give you money. So maybe you really want to buy this house, you really want to buy that car, you need a loan to do it, like we were talking about before, but the lender's just not going to give it to you because you're not seen as a credit-worthy enough borrower. So the credit score can determine, is the lender even going to give you a loan? Then what is the interest rate that they're going to charge to you? This is not something that's uniform across the board. If Joe and I both go to buy the exact same car and we ask for the exact same money, they might extend different offers to us about what our interest rate will be based on our credit background. And beyond loans, our credit score can impact other really important things. When you go to rent an apartment, they're gonna probably look at your credit report to make sure that you're likely to pay them the monthly rent. And if they decide that you're too big of a risk, you're not going to be able to live where you wanted to. Certain employers, they can legally pull your credit report, especially if you're going to take a role where you're going to be pulling some financial strings and things like that. They might do that to make sure that you're responsible yourself. So having good credit is hugely important. I want to use kind of a real example here. So what you see here is the actual interest rates on average, the actual rates for a 5-year car loan, a 5-year auto loan at different credit score levels. So basically someone with a high credit score, 720 to 850, might get extended an interest rate of 3.6% for 5 years. Whereas somebody buying this very same car who has poor credit of 500 to 589 might have an interest rate of 15.24. Now look what that does. If I'm borrowing 25 grand for a car for 5 years at 3.6% interest, my monthly payment's going to be $456, and at the end of 5 years, I would have paid in interest about $2,300 a month. Same scenario, but I'm just a less credit-worthy borrower. So I borrow the 25 grand. Luckily, they give it to me for 5 years, but they give me a 15.24% interest rate. My payment is going to be almost $600. So $150 more per month. Over the course of the same 5 years, I would have paid them close to $11,000. So this is the importance of managing your finances well, making sure you then have a good credit score, because it's going to, when you do need to take a loan, when you do need to invest in some of that good debt, like student loans, like mortgages, like a car loan, you want the interest rate to be as low as possible because it's going to cost you the least amount of money. So I kind of want to wrap up with this. What are the elements of a good credit score then? If we wanted to make sure that we're improving our credit score, or maybe we slip up at some point, this stuff happens and we want to rebuild our credit, understanding what the most important component is what's going to help you either get back on your feet or make sure that you're on the right track. So the biggest component of your credit score is going to be your payment history. They're going to look at, have you made your payments on time? That's why, as I do with so many things to my personal finances, I always set up automatic payment on my credit card to make sure that my payment is always at least in the minimum amount. And so that's the biggest component. Do you pay your bills on time? And this also goes not just for debt, guys. This goes for rent payments and all that stuff. So make sure you pay your bills on time. The other 30%, the other big chunk, is the amounts that you owe versus the credit that you have available. So to give you an example here, let's say that Joe and I are both being evaluated by somebody who's going to potentially loan to us. We both have a credit card that has a $10,000 limit. By the way, when you get credit cards, they also impose a limit as to what you qualify for. And so we both have a $10,000 limit. But Joe, on average, only puts about $10,000 on his credit card every month. On average, I put about $8,000 on my credit card every month. So here we are, two guys. We both have the same credit limit, but Joe is going to look like the much more credit-worthy borrower because the lender is going to say, hey, this guy Joe only spends 10% of what he's eligible to use. This guy Brendan spends 80% of what he's eligible to use. Joe seems like the more credit-worthy borrower. And so using less of what you're eligible for is prudent. Just another pro tip for you guys. I don't come really anywhere near my credit limit from month to month, but still from time to time, I'll call up Capital One and I'll say, hey, Capital One, will you bump up my credit limit? And it's for this reason. It's to make it look like there's a bigger cushion between how much I'm eligible to use and how much I'm actually using, and that's going to feed through to improve my credit score. Some of the smaller components to it, length of credit history. This is something that we can't do anything about. You know, even to my own credit score, this is the reason why I don't have a perfect credit score, is because, you know, they just want to make sure that they see a long period of time. We can't really move that along. But one thing we can do is, as long as you don't abuse it, try to kind of get some credit early on. Maybe get a basic card that you're just putting a couple $100 on. You're sure to pay it off. That's going to start your credit history early and give you more proof to show a lender that you've been a credit-worthy borrower over time. And then some of the other things is just a mix of types of cards. So they want to say, hey, if somebody's had a credit card, a student loan, mortgage, and they've made all these things on time, that's a sign to us that this person really knows how to manage debt. And so that's why that's even kind of a portion of the score. And the last portion, again, only 10%, is how new is the credit. You know, if you were really responsible with credit 15 years ago, but they haven't seen anything since, if they know that you've been really responsible right up until today, it's a little bit less risk. So these are all the components that go into a credit score. So whether you want to make sure you're on the right track, you want to rebuild your credit, focus on the biggest portions first. All right, guys, I know I hit on a lot of stuff. I hope it more or less made sense and was valuable to you. But that's kind of what I had planned for today's presentation, and I think we have a few minutes for questions, so I'll leave it right there.
I got a question. So like, you said if like the debt or the mortgage is paid off, like when you loan from the bank and like you pay it off, you can sell it, but